So, hello everybody. Nice to meet you again. And today is my speech. So it's about financial markets and the role of information and means of spreading this information in the market. We have approximately 1 hour. There is maybe a lot of material, so we will start immediately. Please, if you have any questions, ask them in the chat, and the last 10 minutes I will try to answer some of the questions if you have. So let's get started. Let's see. So first of all, I will tell about a little bit more about myself for you to understand why my speech is more theoretical. I'm graduated from National Research University High School of Economics. It's Moscow. Graduated in 2000s and started my career in the beginning of 2000s in private investment banks. And over the years, I was held in a senior position in investment banking and brokerage firms, specializing in asset management and brokerage service. So I have a theoretical economic background, and I always specialized in stock markets and devoted more than 20 years to financial markets. And one of my interesting experiences was that I was working in Central Bank of Russia as a member of Forex Market Committee, and I was the expert for Russian State Parliament, so-called Duma, where I gained an experience in developing the legislation for regulator of markets. So that's why I am the now the director of Cyprus licensed broker, and I live in Cyprus since 2019. So more than 5 years I'm here, and I'm developing this company. So I have very wide experience in markets. So I was trading almost all possible financial instruments, and I have been, so I know a lot. So let's continue. So a lot of said about the role of psychology in this conference. So it's a critical thing to make rational decisions, to make profitable trades in the market. So we will not dive deep into this topic. And let's start to talk about the role of the data, and how it influences our decision making. So first of all, just simple thing we need to know that psychology itself, it's a response to incoming information. So our brain consumes a lot of incoming information, which we see, we listen, we feel. It produces analysis of this information, and it converts to the decision making. It can be shown on this slide. Very simple general behavior model. So we consume information flows, our brain perceives it, makes analysis, makes decisions. The decisions lead to the result. Result can be positive or negative. And then our brain should correct our behavior or correct the perception of information, not to do the mistakes again or to make better decisions next time. And this is behavior model of a normal brain of the person. For example, it cannot be, so for example, I don't know, gamblers who gamble in casino. They lose money, they bring again money, they lose again, and they always make bets which are not giving them odds in their favor. And this is not healthy brain decisions. This is a model of healthy brain decision. We should correct ourselves. That's it. So, and we need to say that we have two systems of reaction on incoming information. First system is intuitive, fast, and based on emotion and past experience. This system reacts immediately, and it's called in economic theory an adaptive mind system. And the second one is slow, logical, and requiring effort. It's rational. So we can do two parts of decision. First, emotional, but if you will try to invest in rethinking about making research, collecting more information, using our education. It can be hard, but we can make a rational decision. So first reaction is adaptive, fast, intuitive. The second one is rational. That we need to know. These facts are basis for very interesting stream in economic theory is neuroeconomics. So basically, neuroeconomics is an interdisciplinary field that studies how brain makes economic decisions. And I will say a few words about economic theory as a whole. Economic is a part of a philosophy. So it will not give you numbers. It will not give you exact predictions. Instead of that, it's a system of logic which can give you the clues of routes and ways of thinking. And for example, maybe I'm sure you have seen the film A Beautiful Mind. It's called, with Russell Crowe, who is playing the role of John Nash, who this is a scientist who developed a game theory, so-called game theory. It's not about gambling; it's about economic games, and he received a Nobel Prize for his theory. It's one of the ways economic theory develops. And now, very fast developing field in economics is neuroeconomics. And it studies how brain makes economic decisions. It combines several methods of knowledge. It's neuroscience, psychology, and economics. And it makes models which can give you answers of finding the better way to think. And today we'll talk about one of these models which describes the market behavior. Classical economics assumes that people are all rational. It's called Homo economics, but neuroeconomics proves that real decisions are often based on cognitive basis. So it depends on the way of our thinking and depends on what information we consume. And research shows that financial decisions are influenced not only by rational analysis, but emotional reactions a lot. And from psychology, part of these decisions is called amygdala. This part of the brain is perceiving risk, and dopamine system is involved in reward. So risks are being processed by amygdala. And now, if you already understood what we are here talking about, this psychological trading conference is really, it's a part of neuroeconomics too. So about a little bit words about amygdala to understand what is it. You just need to know that it exists. You can Google it. You can find it, how to treat it well. So key functions of amygdala. So first of all, it's a small part of the brain which perceives threats and process emotions. And key functions of amygdala is regulation emotion memory, influence on decision making, and processing fear and stress. One of the examples of what amygdala does is loss aversion. So maybe you know that losses are perceived more intensely than equivalent gains. So if you receive losses, it makes you more pain. Then it's more painful. The amount of pain you receive is not equivalent to the amount of joy you receive if you earn the same amount of money, and this leads to early closing of losses and not giving you the right to close a profitable position in time. So this is amygdala. So applications of neuroeconomics as a part of economic theory. Why do market panics and financial bubbles occur? It's neuroeconomics topic, and it studies the social influence and behavior which can override individual analysis, causing people to follow the crowd, so crowd decisions. And studying neuroeconomics it helps to develop more accurate investor behavior models, enhance behavior finance strategies, and optimize marketing and pricing strategies. So that's why we need to understand what neuroeconomics is. And what is the difference from neuroeconomics from classical economics theory? So usually this is important thing you need to know. You know that in economic theory or in financial markets, there is a term fair value of stocks, for example. And in order to calculate fair value of stocks, the classic economic theory is used. And the basis for this classic economic theory in markets, there are some points which are like in the basis of this classic economics. So first of all, that market prices fully reflect all available information. And information is available simultaneously to all market participants at no cost. So, and there are some, and individual trades do not influence overall price levels. So this is a so-called perfect market. This is the reason why you need to know that is because on this points lie the theory of valuating of fair price for market assets. It's called models, capital assets pricing models, or arbitrage pricing model, APT or CAPM. So whenever you see the research in the internet which says the fair value of stocks, of any stocks is, for example, $100, the basis for these calculations are these assumptions, that market price fully reflect all available information, and information is available for no cost and simultaneously to all market participants. As you understand, this is a little bit far from reality. So markets are not efficient. And now you are, information of course in market is not evenly distributed, because market participants receive information at different time, and access to market information comes with direct and indirect costs. The information costs money. It's obvious. And making good financial decision also requires not only money and access to information, it requires education and possibility to make these decisions. And that makes wealthier investors more, it gives more odds to professional investors in comparison to individual traders. So, of course, in reality, big investors can influence the market equilibrium. So large trades can shift market balance, and less informed investors tend to follow more knowledgeable participants. So usually we follow, for example, big buyer or big seller in reality. And the third point in markets, as we will see later, that not all market participants are really driven by financial returns, direct financial returns from trading. This is one of the key points of my speech, and we will talk about it later. So now you understand the difference between classic economic theory, which is the ground for evaluation of fair market price for stocks, and reality. So now you understand that when you see the fair value, or research which calculates the fair value of the stock, that this calculation is based on very, very controversial grounds. really controversial. So that's why maybe this will give you the answer why analysts can say how many, how much stocks could cost. Why we always see why different analysts give different valuations. Why and why their targets can be achieved or not. And because the theory for these calculations is very weak. And in reality, economics is not a precise science. It gives you the way of thinking, but hardly give you exact numbers. So you need to understand that to treat this information in the right way. And now we are going to build some model based on our real assumptions for market, that information is not distributed well, that it costs a lot, and not all market participants do things which lead to direct profits in trading. So in order to give you this model, we need to classify the market participants in three classes. First of all, we'll talk about active participants and passive participants. So these groups are directly engaged in trading. So it's a traders, basically. But first of all, professional investors, it's usually legal entities. It's not an individual trading, it's a system, so legal entity. A large financial institution whose core business is to trade stocks, to invest, and to give to make returns. And this is a system of people connected in one legal entity. It's analysts, traders, brokers, wealth managers, directors, and their clients. So it is a system. Just small example, Warren Buffett. He's a professional investor. He knows everything. He has a big company. He has a large-scale capital and everything. And comparing to these large-scale legal entities are non-professional investors, so individual traders, in contrast, of course. So it's small private investors or maybe minor investment firms and asset management funds. So they do not have a lot of capital. They do not have a lot of people. Maybe they do not have access to all the information in the market. So basically, they are followers in the market. They cannot move market equilibrium because they do not have enough capital and enough knowledge to do that. Another class is passive participants. This is one of the key points of the speech. Passive participants, they do not trade directly, but they influence the market. So first of all, it's brokers. Brokers, they facilitate trades for active participants and earn commission. The main interest of a brokerage company is in increasing trading volume, like our company. Of course, what income brokerage company receives? It receives commissions. So the more client trade, the more money brokerage company generate. So often brokerage companies interested in increasing clients turnover. And one of the things I need to mention, we are, as Earn Online Broker, we are licensed by CySEC. We are acting according to the MiFID II. This is a law, a financial law in European Union. And if we will encourage directly our client to trade, it's punishable. So this thing we cannot do. So it's according to our license, it's a requirement. So if you somehow connect with a broker who encourages you to make trades, it's basically a crime. It's against the law. You can sue this company. And another one class of passive participants is media and information providers. It's a new news agents, financial websites, business newspapers, analysts, and everyone who is involved in distributing market data or market information. You need to understand that their revenue comes not from trading and not from commissions. They receive subscription payments from advertisement, payments for clicks, payments maybe for marketing promotion of different materials and other things. So they participate in the market in distributing information, but they do not trade themselves. That's it. And of course, we should say that this classification is conditional, but in order to construct an error model, it's fair enough. Okay. So what professional markets participants do? They have access to information and its interpretation. So because professional market traders, they have professional market participants, big legal entities, they have large scale capital, they have early access to market information, and they have possibility, knowledge to interpret, to analyze it correctly. And this makes them possible to make rational decisions. And they, of course, have an influence on market prices because they're large scale, they're buying a lot, they move in markets by themselves, and they see it. And they are interested in making signals and manipulate the market. For example, if we are a large-scale brokerage company or investment fund, and we have a trading idea. What trading idea means? It means that we have an idea that this stock should rise. We have knowledge. It will, for example. What we are doing? We are buying, first of all. And this is called when we decide inside our company to, when we generate this idea to buy the stocks inside our company, it's called buy-side analysis. Buy-side analysis, it's called. So we make decision between each other. We buy the stock. The stock start to rise because we are buying a lot. And then we need to exit from the stock. And who will buy? And the sell-side analysis will help us. So the analyst makes a research, calculates the fair value of the company, we publish it everywhere, and place these stocks, for example, for clients, for our clients, or maybe for in market. So we are interested in making a signal because we are publishing, for example, a research. It's a signal for the market that the stock will rise. What signals can be and so we are interested, if you are professional large-scale investors, we are interested in generating signals to encourage people buy what we are buying, but after we started to buy, and to sell if we have a short position on some company. So it's a manipulative part of the behavior of large-scale professional investors. Okay. In contrast, non-professional market participants. So small traders or small investment companies, small firms, they have lack of specialized notions, they don't have enough expertise, as they do not have access to high quality information. And for example, one of examples how information is received by professional large-scale companies, it's like, for example, a society. If you're making a career in large investment bank, usually you know your counterparties in different other banks. You build your career year by year, and you know more and more people, and these people tend to move from one investment bank to another investment bank, and this is friends socializing. And you, for example, on weekends go to, I don't know, fishing, you meet with friends, you go to somebody's birthday, and you just talk about markets there. And you can, for example, ask your friend about, what do you think about stock A? And he says, oh, really, it's very interesting, we are interested in it. And your mind as a professional investor, you already know they're going to buy. And small investors don't have such possibility. They do not include it in this closed circle of professionals. So they do not have the access to all information, and they do not coordinate their decisions. And of course, the smaller participant of the market is, the more he relies on external signals. So we subscribe on some signals from websites. We listen to market analysts who make really sell-side analysis. So it's sell-side analysis. It's marketing. It's really advertising, marketing. So we are looking for, as a small traders, we are looking for signals which spread quickly and drive markets. So basically, non-professional market participants are followers, and professionals are leading. That's it. This knowledge will help us to build the model. So this is just a summarized table. I will just highlight some points which I already mentioned, but it will help us to develop some tips in the end of my speech. So number of individuals in a group for non-professional participants is small amount of people. Professional participants is a big group. It's a big group. And of course, the capital, non-professional participant has small capital under management, and professionals have large scale capital, a lot. And professional participants receive information first, and non-professional last. And professional participants generate signals for others, and non-professional, they are recipients. They receive and they search for signals from others. And one of the core things is coordination. So professional participants tend to coordinate their decisions between each other. And non-professionals, there is a lot of people, mostly individuals or small groups of individuals. They do not coordinate actions between each other. That's you need to understand. So passive market participants, who are they? First of all, brokers. They execute trades, earn commissions, and tend to encourage higher trading volumes, which is against the law in Europe, but anyway, they tend to do this. Financial media, so newspapers, websites, they distribute financial information. They receive their gains from subscription, advertising, clicks, other marketing materials. So they participate in the market, but not directly. Data providers, the same. They provide access to databases with financial information. Investment consultants, of course, they offer recommendations for investment strategies, and often push clients toward trading activity. So they generate strategies, they generate ideas, they give signals. Okay, and what the activities leads to? First of all, the activities of this passive market participants, they make information overload. So they generate a lot of information, and they constantly produce and distribute news, data. They create a noise, making it harder for individuals to extract valuable insights. For example, there is a saying that what people like. They like sex and horror. For example, you see that last days everyone discusses Kanye West on Grammy and the naked dress of his woman. That's sex. And horror is war. Horror is terrorist attacks and other things. You see, everyone talks about that. And even for example, one example of market horror is, for example, DeepSeek appearance. Everyone talk about that. Like horror, like, oh no, life will not be the same again. And when these passive market participants, mostly financial media, publish these readable instruments, because the more people read, the more revenue they receive. Some information which is really valuable is not being seen by a lot of people. So professionals see this information, but if you read financial media, you don't stick to core raw information data, and you are not able to choose what to read. So these valuable things can be hidden under topics of sex and horror. It's a joke, but anyway, I like this joke. So, and of course, passive market participants, they're interested in involving traders to make some deals. So they do not trade themselves, but they play a crucial role in shaping market behavior. It's very important. Okay, and that's a very interesting slide, which presents the general models of stock market participants' interactions. So to sum up what we were talking about, this I will explain in more detail. So we have some future. So in the bottom of this graph is a timeline. The timeline. In the right part of the slide is future. Future is generated by rational expectations. So it's some future which no one knows, but which will be. And this future gives. So how? So first of all, we have forecasts. And if we have more rational forecasts, they come true. So the future is coming slowly. And the more precise forecast is, so forecasts tend to form future. That's how it works. So, and okay, let's move to the first part. So it's called zero part. So this is a scope of actions of professional participants. So professional participants receives information first. They receive information and build their rational expectations, which are closer to the real future it will be. So they make precise predictions. So they receive raw information, full information. They have complete information field, because they have access to all of information. They receive that information, they analyze it, they develop and execute their investment decisions. So they start to buy or sell, and then they are interested in forming signals. So they communicate with media, or they generate signals by themselves. And the turn. So now passive participants start to act. So what they do? They publish information. For example, just simple example. You know that there is, for example, two big news agencies, Bloomberg and Reuters. Bloomberg gives a news announcement on its system. Who receives it? The people who have subscription. It costs several thousands a month, this subscription. It's a lot of money. And Reuters, for example, the same. And after that, so professionals receive this information, they already start to do decisions. For example, simple example, statistics on CPI. Who receives it the first? The next very second it published, professionals receive this information. If you do not have subscription for Bloomberg or Reuters, there will be a delay for 15 seconds, and this is enough. And the same to all of this information. So first recipients of information is professionals. Then information publishers, websites start to republish this information and to add analysis of experts. For example, asking the same representatives of brokerage and investment firms to make their comments on this information. And they publish articles. So in reality, raw information already been received by professionals and all trade was made. And after that, media start to publish informations. And only after that, on the third stage, retail investors receive this information. That's why I call them followers. So we are usually, if we play a role of sole trader, we are followers. You should understand that. So, and professional participants, they have complete information field. Passive participants, media, basically, they already work in incomplete information field because they write, even if they wanted to write about what people really need, the people will not read about some dull things about profits and losses of one company or an industry, or it will be written, but not in the way it's done. And they receive comments from other professionals, and these professionals and representatives of professional participants, they tend to encourage their publicity, they encourage their subscriptions to present themselves, so they are biased. So they publish biased information. And the information field in which we individual traders work, it's this information field, it's already not only incomplete, it's biased and fragmented. And this is why the smaller investor is the harder to make the right decision. So, and after individuals make their decisions, they altogether influence on the stock market price, and this loop starts again. So, and this model, for example, explains the self-developing processes. The simple example of self-developing process, it's, for example, startups, the company which is not really generating anything. They place stocks, they make marketing of the stocks, brokers start to tell investment companies, how these stocks are prospective, how they're going to rise in the future. They publish this information. A lot of individual investors start to buy, stocks rise again, and this company makes another round of share placement. And this loop starts again. So this is called self-development process. So this model explains that. And this explanation helps you to understand the position you have in markets. And this model, it's a neuroeconomic model. This can give a ground to develop some tips on how to avoid mistakes and what to do, because we are here to discuss psychology. Why? In order to increase the efficiency of our trades. And so let's see the tips which are generated by this model, which can be proved by this model. So this I already told. Okay. So first of all, the conclusions which we should make from this model, first of all, is filter information. It's one of the core things in trading. Filter information you receive. Do not overload your brain. For example, when we media, they tend to speak about these hot topics, and they publish all the same, with different opinions, maybe of different people, but they publish all the same. Don't read the same thing multiple times. You know that if the lie is said to you 100 times, it became truth. The lie that have been said 100 times became a truth. So don't read the same things again and again. If you see the topic, you already received the information, switch to another thing. Find things which are hidden by this overload of the same information about these hot topics in media. Choose reliable sources. do not consume everything. So the brain tends to seek the confirmation of your existing views. So don't look for the news you want to see. For example, if you are long on stocks, don't search for positive news. It's a mistake. Think about about reliability of information. Think about how about the food. So like food, you are not eating from a trash can. So if you eat trash information, what decisions you can make? So carefully select authors, carefully select sources of information, and stick to these sources, you think they are reliable, you trust. And focus on analysis, not marketing. So good analysts, and when you speak to someone, they encourage discussions and provide feedback. So be cautious with people or media who simply promote their trading ideas without explanation. So if you have, for example, trading idea, without explanation of logic behind it, it's about timing. So if you have an idea, trading idea, it should have specific time and specific levels. So, and it should have if-then analysis, because it depends. So avoid just simple words of buy the stocks and that's it. It's not a trading idea. So focus on analysis and try to avoid marketing. When you read some article, if you think about it, you will easily understand what is it, marketing or a real trading idea. It's first of all, so the second thing, very important thing, invest in a team. So build strong connections with people and investors you trust. So there is a saying, you should trade alone, never disclose your positions to anyone, never discuss your trading ideas. Bullshit. The optimal team size for trading is 3 to 5 people. In investment companies, it's usually chief trader, the analyst, and the vice trader. So 3 people, up to 5. You discuss trading ideas with them. Teamwork enhances information processing. Just like if you have multiple processors in a computer which work simultaneously, because 5 people or 3 people can consume and analyze more information in the same given time. So work in a groups with friends. With maybe you establish online relations with someone you trust. So discuss with them idea, discuss the strategies. And when you explain your idea verbally to someone, it psychologically connects you to this idea. It helps you to avoid mistakes, and you stick to the strategy. And to break, for example, if you open the position for a 1 month perspective, it will be hard to close it because you need to talk to people and to generate a single decision from discussion, like an investment committee. So build a group. Don't trade yourself. Try to build a group from people you trust. Of course, the thing, trade what you understand. This important advice is imagine how many people trade, for example, Tesla stocks or Apple stocks. Imagine, lots. Nvidia stocks, lots. For example, if you trade Forex, euro dollar, central banks are playing this game. If you are going to try to raise capital of trading euro dollar Forex pair, you are going to play against central banks of the world. The more professional investors really do not exist. So find an area in which you can specialize. And just a simple example, if you, for example, a doctor or you have a degree, a medical degree, you understand medical pharmaceutical companies more, maybe more than investment bankers do. If you work in airline, use your knowledge, use rumors in the industry to analyze it. This can give you advantage. Don't be afraid to trade small capital stocks, because the smaller players are, the less the gap between you, individual trader, and and them exists. So find a game in which you have advantage. So know what you trade. Then, of course, invest in financial education. So, of course, as I said to you, economics is a philosophy. It's a part of a philosophy. It was before it was educated on the philosophical faculties of universities as a part of philosophy. So it's not a precise model. It's not a precise calculation. It can be learned. You can understand trading. You can read a book. It's not like rocket science. You really do not need to attend university to trade stocks. It's just the way of life, the way of things you do. Car mechanic have the same level of knowledge. So you can read books, you can understand it. So don't be shy, just continue to educate yourself. It's not a rocket science. And of course, the simple thing, do not rush unnecessarily. If you know already about emotions, emotional decisions, and rational decisions. Rational decisions take time. So decisions should not be made quickly. Quick decisions should be made, but if they are planned in advance, if you have if-then analysis, so you prepare the plan of your decisions making. So you just execute decisions which were made before. This is execution of decisions. So this should be quick if you pre-planned it. But if you have, for example, read something news and you are rushing to buy, do not do it. Discuss it with your team. It will take time, and the team will help you to filter your brain. So this was discussed before. So do not rush. And number 6, very interesting idea too. It's very simple, but not everyone understands. There are more than just 2 positions in the market. Exactly, there are 3 positions in the market. So one is long, one is short, and one is cash. The cash is position 2. And the one tip I can give you, if you cannot make a decision, for example, usually some traders, for example, they try to trade like they're going to work, and if they do not execute trade today, they're, like they've done nothing. To do nothing is the market. Is common thing. It's to wait. And this is the hardest decision, to wait for opportunity, to wait not even for opportunity, to wait for your brain to make a clear decision, to wait for the moment when you have a clear idea. And if you think about your assets you choose before, you have mixed idea. So you have something, some positive signals on this stock, some negative signals, and you can't make decisions. What is more valuable, positive tendencies or negative tendencies? So pros and cons are balanced. You can't make a decision in favor of long idea or short idea. Do nothing, because in this very moment, likely you are facing a sideways market. So if you cannot make a decision, know that usually it's the signal for a sideways market. So if you mixed in your brain, do nothing, stay away. And the last my tip is learn option trading. So there is a financial instrument option, which is widely accessible financial instrument, and it allows effectively management of uncertainty. It allows you to effectively manage uncertainty. It's like an insurance. Maybe you will feel not easy when you start to learn options, but the power which can it give to your positions is hard to overestimate. So learn option trading. This will help you to hedge from uncertainty. This is really only one tool which can be used to deal with uncertainty. So I think that's it. So I have 5 minutes left. I will go through questions. The first question, can depression be a result of amygdala hijack too? Really, I don't know. I'm economist by the nature, so and neuroeconomics is a intermediary discipline, and so it's, sorry, I don't know. I'm not a psychologist. It's more the question to psychologist. Mm-hmm. So how do different types of traders, institutional with retail, react differently to new information? Of course, if we assume that they are receiving information in the same time, which is usually not in reality, it depends on their knowledge and their experience. And this I must say that, of course, professional investors, they are experienced, they well educated and experienced, and they receive the same information, but they make different decisions based on it because they analyze and perceive it in different way. So we can receive the same information, but we can make very different decisions. Because professionals, they have more experience, they have more knowledge. So the decisions can be really opposite. So they make really different decisions. How do the professional investors keep the available information away from smaller ones? It's very simple. They just don't tell it in the news. So they just do not give comments on it. For example, as I mentioned before, buy-side analysis. What is buy-side analysis? It's not like a paper. It's not like a note. It's the result of discussion. It's the result of meeting between the members of the team. So we discuss some trading idea and we decide to buy. And of course, no one discloses information to media. Media comes to investment company to make comments about some news, about something, but not about, they do not ask what your company is trading. So it's very simple. So we just, no one publishes its real trades they do. No one. That's it. So it's the normal situation in the market. Why is it hard for small investors to copy the actions of professionals? In reality, the small investors should copy the big investors, because what we are seeking for? We are seeking the growth for the capital. We are seeking for the growing trade ideas. No, if you play in long, of course. If you play in short, falling. So, and we are individually cannot shift the market balance. If I buy stocks on my money, it's not a billions and trillions. I cannot shift the market equilibrium. Only large-scale investors can. So basically, our purpose of individual investors is to find the signals, to see the market, to look for it, and to try to understand what professionals do. So if you are referring to this model, we are trying to get from this fragmental information field, try to jump to the field where professionals work. We should solve the puzzle they give. We should find and catch them red-handed if they're buying stocks. So we are looking for signals if they're engaged in buying a lot of stocks. So it's hard to find. No one publishes their strategies. No one publishes their deals. So our purpose is to find the big bear and to stick to it, or to find a big bull and to stick to it. So that's what we are looking for, because only big bulls and big bears move the market. So usually we are trying to understand what ideas of big market players are, or the ideas of the crowd itself. Maybe yes. So provides the information to the professionals. Who initially provides the information to the professional investors? So usually, of course, I mentioned Bloomberg and Reuters. It's just simple information. But I, for example, provide the example of Warren Buffett. He has a very good book called essay on financial markets, as I say, or essay on investment. And what he says, I'm buying a company, I'm putting my man in the board of directors. Why he does that? Have access to early informations. And he says, I'm not going to buy a company which is being managed by a person who does not deserve to marry my daughter, for example. So when he chooses a manager of the company, he knows his personality, he knows his plans, his fantasies. And these fantasies and plans are not published by media. So that's why. So he established close connections to the management of the company, puts his people in the governance of the company and the management of the company. And that's how he accesses to raw information by like plans, fantasies, and other things. That's one of the means to, so it's, he possesses inside information no one knows. And that's why he buys big stakes in the company to have access to the management. That's why. So, okay, we have some more questions, but sorry, time is up. So I want to thank you everyone for being here. Sorry for my bad English. I'm not a native speaker. But anyway, thank you everyone. So I hope this made interesting for you. Thank you.
Yes, thank you so much, Sergei. Let me share one of the feedback from the chat. Excellent presentation, Sergei. Thank you so much. And you need to follow all the comments in the chat because a lot of questions to you. It's a kind of fresh air during this conference, new approach, a lot of data. Thank you so much. But one small question from my side. So what is approach? What is the difference in approach from the side of professional investors and non-professional investments to the question of security? So because so they perceive security differently, professionals and non-professionals. What do you think? What is the difference?
Sorry, I will clarify. What do you mean security?
Yeah, so how secure is to go in trade? How secure they do feel in their lives? So professionals and non-professionals, and how they behave according to their perception of security in life and in trading as well.
So how to lead a healthy lifestyle?
not only, but a healthy, trading life as well. So because.
Maybe I'm not sure that I correctly understood the question, but I have a joke on this. So I'm devoted almost all my life to financial markets. I made this decision in early stage of my university, and I must say that my life is very interesting but stressful, and that's why I'm a cheerful person but angry.
Okay. It's a very good answer to this question. Thank you so much, Sergei. It was very insightful. Thank you so much for joining. And now I understand why Earn Online Broker is so great. So thank you so much for sharing your ideas and your researches.